Hello everyone, my name is Jim Hunter and I'm a Senior Portfolio Manager at Johnson Investment Counsel, and this is the JIC Research Edge. I'm joined today by our firm's founder and chairman, Tim Johnson, for the first installment of a 2-video series. Tim founded Johnson Investment Counsel in 1965 with a focus on helping others and providing guidance that would ultimately improve clients' lives. In these videos, we'll be discussing some of Tim's experiences and life lessons from his 50-plus years in investing. Tim, let's step back to the beginning of your career. How did you get interested in investing, and how would you say the field has changed over the years?
When I first got started in 1965, I was working for a large public company, and I had the opportunity to become the liaison between the company and their pension plan manager in New York City. And I went back and forth quite a few times to do that. And that really was a wonderful opportunity to see how the industry really operated at that time. And in 1965, 66, the New York Stock Exchange had its first 10 million share day. That happens in milliseconds right now, just the first few seconds of the opening of the market. In those days, everything was centered on stocks and bonds. There weren't a lot of other alternative investments. Things were simpler. And then came the advent of the computer, and the computer changed all kinds of things. It allowed a lot of fast trading. It allowed a lot of institutional investing that didn't happen before. It became rather oriented from day-to-day kind of trading and really not very important for the average investor. It really wasn't investing, and it brought about a lot of speculation in the market.
Right. Those are some big changes. It's said, Tim, that smart investors sometimes have simple investment rules to help them play to their strengths. For example, Warren Buffett says that he will never buy a company he doesn't understand, which speaks to sticking to what you know best. He's also known for saying, be fearful when others are greedy and greedy when others are fearful, which speaks to the emotions that can overtake an investor when the markets are volatile. Do you have any rules or mindsets that you follow that you could share with our clients?
Well, the emotions of an investor is probably one of the biggest negative that they have. You know, people in times like we're just having now, we've had over 12 years of a bull market, and investors are, especially the public, are very interested in owning stocks. There's a lot of stories about how things have doubled and tripled, and so there's a lot of buying by individuals now. When the market drops, people then want to sell. And it makes no sense. It's very irrational, because when you go to the store to buy a product, you're really excited when prices are low. And you want to buy then, and then when prices get a little on the higher side, you don't want to buy. It's really the opposite of what an investor ought to do. If investors would just stick with a time-tested process, it would take care of the up and downs in the market, and they wouldn't have to be so concerned about that and be so emotional about it. And it would really take care of them for their long term.
Over the years of your career, Tim, obviously the market has had its ups and downs. Are there any specific memories that stick in your mind, and what do you think you've learned from them?
Well, most recently, this downdraft of 2007, 8, and 9, when the stock market fell 55%. That was a very difficult time for people, because it really was a problem of the collapse, potentially, of the financial system. And that created a lot of difficulty for individuals to keep focused. During those times, investors who had a good, solid, diversified portfolio of high-quality companies really weathered an awful lot of those difficult times. Patience was very, very important. Another difficult time was when I started in 1965 to 1982, that 17-year period. The Dow Jones Industrial Average went from 800 to 800, basically flat for 17 years. You got the dividend, that was all you had, about 3.5% a year. After that time, the market did considerably good, and from 1982 to 2000, it had one of the greatest bull markets in our history. And then, of course, the market got in trouble during that next decade in 2001, 2, and 3, and then again the 55% drop in 7, 8, and 9. Then after the financial collapse in 2007, 8, and 9, the Dow Jones got to 6,600, and today it's 35,000. In each of those bad periods, that 17-year period and in the 2000 to 2009 period, right after those periods, we had those extraordinary gains. And so long-term investing is absolutely the key to one's success.
That's some really great perspective. Thanks for your time, Tim. And thanks to all of you for watching at home. Keep your eyes out for Tim and I's second video, which we look forward to bringing to you in early 2022.